Yeah, you realize that here, you realize that at this point, we're looking at the 1 minute chart, right? At this point, a new market is opening. A new market is about to open because we're on 1 minute charts. See what just happened? It opened here. This was where it opened, right? Let me put a line there. So it's black, so it's visible. Another one is opening here. You can see it opened there. So we're going to wait again to see what's going to happen. See the time here is counting down. So the market is moving up. That's gone down. So this candle closed here and it opened because it was 1 minute. It opened here. Let's wait for it to close again so that we can mark it. It's counting down 1 minute. So we're realizing that every 1 minute, this candle is opening and it's opening at a price and closing at a different price, right? It's opening and closing at a different price. Let's wait for this one to close. Now, because it's Sunday, the movement is going to be very haphazard. It's going to be everywhere because it's Sunday. So it's a proper weekday, the movement will be more stable. Maybe we should take a class on a weekday so we can see. So the market closed here, right? Now, if we're looking at it in the same way we're looking at our bar chart, we're going to realize that the same way our candle chart opens and closes is the same way our bar chart opens and closes. But the difference is that it's not represented in a candle. When it comes to the bar chart, when your candle opens, at that price, it just shows an horizontal line at the left. And when it closes, at that price, it brings out an horizontal line at the right. Now, this vertical line here is just to show you the highest price that happened during that time frame and the lowest price that happened during that time frame. Do we understand? Do we understand? Can we hear me? I can't hear you. Can you hear me?
I can hear you.
Yeah, do you understand?
Yeah.
Okay. So now the next one is the line chart. Now the line chart is just a straight line that is drawn on a simple line chart from one closing price to another closing price. Now, the line chart from what you're seeing here is just a line that is showing you from one closing price to another closing price. Let me show you this. If you change this to, I'm sorry, a line chart. All this line chart is showing you is where at this time, as at, let's change this to daily charts, right? All this is showing you that on February 10th, this market closed at this price. On February 24th, this market closed at this price. On February 28th, this market closed at this price. All the line charts can show you is where the market closed at that particular time. The line chart only shows you the closing price. It does not give you the opening price. It does not give you the highest price that happened during that time frame. It does not give you the lowest price that happened during that time frame. It just gives you the closing price. Now, the good thing about this line chart is that because it gives you just the closing price, it helps to detect the overall movement of a currency pair. So all you can detect through the line chart is that this market is going up, or this market is going down, or this market is just on a straight line. That's the highest that you can detect with a line chart. So now, if you look at this line chart down here, the only thing that you can say is, okay, this from here to here, it was somehow going sideways, then all the way it went down, then it went up, then it went down, then it went down, then it went down. It cannot really give you any piece of information apart from just the movement of the pairs. Now, you now have the candlestick. The candlestick is what we are using, right? So the candlestick is just like the bar chart because it gives you the opening price, it gives you the closing price, and it has two major parts. It has the body and it has the wick. So this is the body of the candle, this fat part, and then the tiny parts they are referred to as the wick. So now let me explain something about the candle. When you see a candle like this wick here, the higher wick is the highest price that happened during that time frame in the market. Is the highest price that happened during that time frame in the market. That's the upper wick. The upper body is the opening price. It was where this candle opened. If our market is at 1 hour, if we're looking at our market at the 1 hour time frame, let's say it's 2 o'clock. It means that immediately it was 2 o'clock when this candle opened. It opened at this price. That's what the upper body says. The upper body says that immediately this candle opened, this was the price that the candle opened with. The upper wick tells us that throughout the time frame of this candle, in the 1 hour that this candle was opened, the highest price that this candle went is this upper wick. It did not go higher than this. Now, the lower body tells us that this is where this candle closed. This is immediately 1 hour was over. Immediately this candle opened at 1 o'clock. Immediately it was 2 o'clock. This market closed at this place. Now, because this market closed at this place, didn't mean that the market did not go lower than that. No, the market went lower, but the market still went up. It means that within that 1 hour time frame, the market made a lot of movements. It went down, it went up, but immediately it was 2 o'clock. The 2 o'clock met this market at this place. So that is where the body of the candle will end, because that's where 2 o'clock met the candle. So the candle will close at the lower body. Now, the lower wick just tells you that this was the lowest price that this candle did when it was open. Do we understand? So now, the difference between the red color candle and the green color candle is basically that this red color candle is indicating a bearish market, while this green color candle is indicating a bullish market. We're going to go into that detail as we continue. So now this is just the candlestick chart and the bar chart. Now, obviously, now when you're looking at it, you realize that for better understanding, for just to make life easier, the candlestick is just better than the bar charts, and the line charts do not even have anything to offer us apart from movements. So we are not even dealing with it. But the better one in what we are seeing that just looks good and it's just better and it just looks easier is the candlestick. So this just shows the difference between the bar chart and the candlestick. Now, support and resistance. Now, this is resistance, this is support. Support and resistance are two things that you're going to be hearing over and over again in the foreign exchange markets. Now, in technical analysis, support and resistance are two fundamental ideas. Remember what I told you about technical analysis? I told you that the foreign exchange market is basically I told you that the foreign exchange market is basically a recycle process. Everything that happened in the foreign exchange market has happened before. There is nothing new that's happening in the foreign exchange market. That's what I told you, right? So now, technical analysis now, I told you for the fundamental analysis, they use the idea of what has happened before to judge what is going to happen now in the market. While the technical analysis, they use the same idea, but they add indicators to it, right? So now, support and resistance are very fundamental, because it is because of support and resistance that you'll be able to know that, oh, this was what happened in the market last 2 years. Now, the basic idea of support and resistance is that what happens in our foreign exchange market is demand and supply. Remember what we said earlier about demand that traveled to Japan. When he got to Japan, he bought Japanese yen for naira, you know, and by the time he came back, the prices had already changed and he made a lot of money, right? Now, because of supply and demand, prices fluctuate. For example, now, if you look at what's happening in Nigeria now, because there's scarcity of naira, everything seems to have increased in price. Now, why is it increasing in price? Because supply cannot meet demand. Because for example, now, what people have in their shop is not sufficient enough for the amount of people that want that thing. So let's say now, for example, now 400 people want to eat apple, but there's only one man that is selling apple, and that man only has 100 apples. Now, the price of that apple is going to increase because there's increased demand and supply is very small. So whenever prices increase, it's because supply is small and demand is heavy. So you know that definitely you're going to make sales. You are going to make sales, and it's going to be on a first come, first serve, basis. So prices increase when supply is small compared to demand. So that's why you're seeing now that POS people, they're increasing their money because supply is small, but demand is very high. But why do prices decrease? Prices now decrease. You see, prices begin to go down when there's supply everywhere, but there's no demand. So if everybody now, if you have about 4,000 apple shops in Abuja now, and just 100 people need apples, if you are selling your apples at 1,000 naira, another person is selling his apples at 1 naira, you can be sure that nobody will branch your shop because there's nothing special about your shop. Everybody sells the apple. So prices reduce when supply is more than demand, but prices increase when demand is more than supply. Do we understand? Now, when you have equal amounts when supply is equal to demand, prices are very stable. They are stable. It might not remain the same, but it will just be fluctuating around the same area. It will just be bouncing around the same area. It can just be between 4 to 6 naira, just bouncing around the same area. But when supply is everywhere and there's little demand for it, obviously the prices will be very cheap. But if there's heavy demand and little supply, prices will be very high because the supply people begin to feel special. Do we get it? Now, this applies to what? To support. Now, support is that area on the price chart where it feels like the buyers are having the market. They are ready to buy. There's demand. There's demand. It means wherever you see support is that area, is that level in the chart where there is increased demand. And remember, when there's increased demand and you now have reduced supply, what's going to happen? The price is going to increase. So now it means that support are those areas where you have a lot of buyers that want to buy. They want to buy in the market. And what do buyers do in the foreign exchange market? They push the market up, right? So they push the market up. That's what buyers do. They increase the market. They cause the bullish market to happen. They give room for the green candles. So support is any region on the price chart where the buyers are ready to buy. Why resistance is the opposite of support? I'll come back to all this big story. Resistance is the opposite of support. Resistance is that point in the market where the sellers are ready to sell. There is more desire to sell. Now, people usually refer to as support and resistance as the ceiling, while support as the floor. Resistance is the ceiling, while support is the floor. Now, remember what we said at the other time. We said that people like to buy low and people like to sell high. People like to buy at low prices and people like to sell at high prices. So obviously, if you go to the market and you see peanuts for 20 naira and you see peanuts for 100 naira, you want to buy the peanuts for 20 naira, right? So that when you come back home, you can now sell your peanuts for 150 naira. That's the same thing. So support are the floors of the market. They are the low points of the market. They are when the prices are low, that people are excited to buy because they know that this thing is going to jump up. While resistance are the ceilings of the market, where the prices are high and sellers are excited to sell because the price is high and they are going to make a lot of profits. Do we understand? Now, what we said about demand and supply is now coming into play here when we now look at market trends. Now, there are three major market trends. We have the bullish trend, the bearish trend, and the consolidating markets. Now, remember, we said when there is supply and there is no demand, price will reduce, right? But when there is no supply and there is demand, price will increase. That's what happens in the uptrend markets. What happens in the uptrend market is that people are buying, but there's nobody selling. So because people are buying, nobody is selling, the price will continue to go up. Do we get? That's what happens in an uptrend market. People, all that is happening is that people are buying. The same energy that people are using to buy, people are not using that same energy to sell. So what is happening is that there's demand, there's high demand. People want this stuff, they want to buy it, but there's nobody to sell it. So that's what happens in the foreign exchange market when there's an uptrend market. When there's an upward movement of the market is just going up, the price is increasing because a lot of people are buying, but there's nobody selling. So in that situation, you're going to have an uptrend, which is going to lead to an increase in price. Do you understand? I should go slowly. Do we understand? What did you say?
Line again. I said just re-explain this uptrend again. I understand the supply and demand, support and resistance. Just this part, just explain it again.
So now I said that the uptrend, what happens in the uptrend is that you have a lot of people buying, meaning you have a lot of demand. Now, demand is the same thing as buying. You have a lot of demand, but you don't have a lot of supply. People are not selling as much as people are buying. There's increased demand. People are buying. And what's happening when people are buying? The market is going to continue to go up. So perfect. Now see this market. Now, if you look at this market started from here and it ended here. It started from 0.97541 and it ended at 1.10053. Now, what happened between here and here is that there was increased demand and little supply, meaning that from here upwards, people were buying a lot. There were a lot of buyers. Look at the green candles, a lot of buyers. But compared to the supply, if you compare the demand to supply, it's quite little. The demand to supply is not equal. The demand is higher than supply. So what happens is that when you have a lot of demand, when you have a lot of people buying and the people selling are not equating that energy, the prices are going to continue to go up. So what happens in an uptrend market is that you have a lot of buyers. The market is buying. The market is buying. You have a lot of green candles. The market is buying. So because the market is buying, the prices are increasing. The prices are what? The prices are increasing. So you see, they've been buying from here. They bought here. They bought all the way to this price from 913. They bought, I'm looking at just the three last numbers after the decimal. They bought to 482. They bought again. They bought to this place. They bought to this candle here. Then supply came, but the supply could not match up the energy of this demand. Just look at the supply, just a little. And then the buyers still continued firing again. They fired. Supply came, but it still couldn't beat it. Supply came, but it still couldn't beat it. Buyers kept on buying, buyers kept on buying, buyers kept on buying until they bought all the way up. Now, the fact that they are buying makes the price to increase. The price is increasing because you don't have a lot of people selling. So what happens in an uptrend market is that it's a buying market. You have a lot of people buying. You have a lot of bullish activity happening. People are buying and not enough people are selling. So because people are buying, price is increasing. So an uptrend market is a market where the buyers have a higher stake in the market. It's a market where it's a buying market. It's a market that is going upwards. It's a market that is increasing in prices. Do we understand? The whole demand and supply is just the logic behind why it is increasing. But the plain English is that an uptrend market is a market that is increasing in price, is a buying market. Do we understand now?
Yeah, I understand.
Yeah. So now, it's almost the same thing now with the downtrend market. The downtrend market is the opposite of the uptrend market. What's going on in that market is that it's going down. Why is it going down? Because you have more supply than demand. So because a lot of people are buying, a lot of people are selling, the market is going down. The market is going down. A lot of people are selling, so the market is going down. Let's check if we see anyone here. Perfect. This is just beautiful. So now, if you look at this market now, we realize that it's going down. And why is it going down? Because a lot of people are selling. A lot of people are selling. People are selling. A lot of people are selling. People are selling. So a downtrend market is a market that is selling. A downtrend market is a market that is selling. The market is going down. We have a lot of sellers. So it's just the opposite of an uptrend market. A downtrend market is a market that is selling, is going down. You have more supply than demand. More supply than demand. So it's just going down. Now, the last move that we have in the market is the consolidating market. Now, the consolidating market is a market that's moving sideways. Now, if you look at consolidating market, the market is not going up, the market is not going down, it's just going sideways. It's hitting the same points, up and down, up and down, up and down. So you see this market is doing the same thing. It's not passing this limit. It's just hitting up and down. Let me show you here. This market really went down. Okay, perfect. Now, this is an example of a consolidating market. A consolidating market is a market that is just moving in one direction. It's not going up, it's not going down. So you see what is happening here right now. This market is just between this place. It's just going sideways. It's just going on a straight line. It's just going sideways. So this is a consolidating market. It's a market that is just hitting, bouncing up, just going up and down, just going up and down, in sideways, in a straight line, just going. So this is a consolidating market. It's neither going up, it's not, there's no, demand is not more than supply. Supply is no more than demand. Demand is equal to supply in a consolidating market. The same people buying, the same amount of people buying, the same amount of people selling. So it's just, the market is fairly stable until one person now decides that, oh, this market is too gentle, let's shake things up. But a consolidating market is a market that is going sideways. Demand is equal to supply in a consolidating market. The same energy people are using to buy, the same energy people are using to sell. Do we understand? Now,
yes.
So this is everything that we've just discussed today. This is an uptrend market. Buyers are buying. Any market that is going up is an uptrend market. Any market that is coming down is a downtrend market. Any market that is going on a straight line is a sideways trend. Look at this. Very wonderful uptrend. It's just going up. This one is coming down. This one is going up. So that's just basically it. So the next thing that we're going to look at is indicators. This is the last thing that we're going to look at that will enable us to be able to understand perfectly our charts, and so that we can be able to take these trades. But now, because we want to be trading currencies and we don't want to trade crypto, these indicators, I have to explain them when the market is moving on what we want to trade. So it means that we have to have a class this week on Thursday or Wednesday. So Thursday or Wednesday by, let's say 9:30. Let's say Wednesday by 9:30, fine.
No. Well, 9:30, I'm okay with that time.
Okay, Gloria, come.
9:30.